The decision to keep the federal funds rate steady at 2% marks the first time in 10 months that the Fed has not cut interest rates after one of its regular meetings. In a brief statement explaining its decision, the FOMC said overall economic activity is expanding, but uncertainty about inflation remains. Reading between the lines, Standard & Poor's analyst David Weiss says that means interest rates are likely to go up after the Fed's next meeting in August.
Basically, the economy is doing a little bit better than expected right now, and that's good news. And on the other hand, inflation's doing a little bit worse, which is bad news, but both of them are pointing to the fact that the next rate move is probably going to be up, not down.
The Fed has been cutting interest rates since September in an effort to boost the U.S. economy. But cutting rates too low can boost inflation by making it cheaper to borrow money. Weiss said the Fed move strikes a good balance.
This was a slightly softer statement than people expected, which I think is going to put off their expectations of any Fed rate hikes. And as a result, the stock market's happy. They were afraid that the Fed would raise rates too soon, prematurely, and increase the risk of a bigger downside spiral.
The central bank's benchmark rate influences interest rates for all kinds of loans. Wednesday's decision means that borrowing costs for home mortgages and other loans will remain unchanged for the time being. Arcega, VOA News.